Hello YouTubers, and welcome back to the Independent Investor. Today I'd like to talk about a position I opened about a month ago, I guess now, and it's in the restaurant sector, but with a bit of a unique spin. This is an American company, Dave & Buster's. The stock symbol is PLAY, Play, and it trades on the NASDAQ. I came across this just doing some research. I think initially it was reviewing a Value Line report. I subscribe to Value Line. It follows about 1,500 U.S. companies, and has a one-page report on each of these companies. They issue that about 4 times a year, so it's a fairly quick way of getting a pretty good overview of the U.S. market. Dave & Buster's did, as you can see on the screen behind me, got up to about $74, which is quite expensive for its growth and for its earnings. And I paid some attention to it because it came down into the mid-50s, and it looked like it was kind of maybe going to turn around at that point. At the $55 level, it was still expensive based on earnings, but the company has pretty steady growth, and as I've said quite a few times, it's getting harder to find somewhat reasonably valued companies in this market. So I opened a small position, and like I've said in the past, I typically just open a very small position and see what happens and how it develops, and it gives me time to do more research, which I did. I spent about a day going through the last couple of years' annual reports and filled in a spreadsheet that I used to analyze companies, and really came across nothing too alarming. The company is fairly well managed. It's had about 16 quarters of same store sale increases, and they aim for about 10% growth each year, and that is done by opening new stores, new restaurants. But what really grabbed my attention was that the restaurant business is extremely competitive, and you know, consumers' choices change. But with Dave & Buster, what I found totally unique is that they have a gaming and arcade business, which is in the restaurant. And this generates about 40% of their revenues, making it quite unique. And also, so this is the spreadsheet that I spent today. So it comes under amusement, and you can see like sales for last year were $1 billion. Food and beverage was $452 million. But the amusement side was 553, so the amusement actually brought in more money. And I can't think of another restaurant chain that mixes both entertainment and food. And they're always remodeling their restaurants. They try to cater a bit to the area. It's also a bit of a sports bar. They've got big screen TVs. And then they have a whole section where it's a bit of an arcade and new games. And they stay on top of the games. They're always doing new themes in their restaurants. Like I think right now they've got a Breaking Bad theme. They've got Pirates of the Caribbean. Of course, this is expensive for them to change these games out on a regular basis, and there's quite a capital cost involved, but they seem to generate good cash flows and profits from this. They've got like a card that you can purchase and then use that to pay for the machines, and it's there's like a lottery component in that, where you can win a certain game and maybe get points on your card you can use next time or cash in. So it's got a really strong branding in that sense. And again, I come back to that it's just unique. I always like companies that have something unique about them. And it's strange, really, that a competitor hasn't came into the market to compete with them. They've been open for quite a few years now. And the overall, the revenues are, I say, growing about 10%. 2014, 635 million, and 2017, we've got about 1 billion. And all the other numbers have just kind of moved along with it. Nothing really too outstanding. They have been buying back shares, which I'm not a big fan of, especially if the company is expensive, because it just kind of takes away from the book value. But they've been buying back shares, and the debt's also been decreasing at the same time, so that they are generating quite a bit of free cash flow. And you can see cash flow is actually double over the last couple of years. From cash flow from operations went from about 100 million up to 230, and they've invested capital flow for investing was about 160 million. So they generated about 70 million just in free cash flow, which is pretty good for a very competitive business. There was some of the working capital ratios, the quick ratios, were a little bit on the lower side. You can see here they're flagged yellow, but the actual interest rate coverage, because their debt is quite low, is 21 times, so there's no problem with them servicing their debt. And all these ratios have kind of improved over the couple of years, so it tells me they've got a pretty steady hand on the till there. And operating profit margins have actually been increasing up to 60%, and the net return on equity again has been trending up as low as 1%. Now we're at about 20%. Same with owners' earnings; they've increased, and the equity or book value per share has increased quite a bit. So again, they've got about 92 restaurants open right now. Comparable store sales, as I said, have been increasing. They're 3.3% year over year, which is pretty good, as we know retail is having a real hard time right now overall, and just because the changes in how people purchase and their lifestyles. But it's doing quite well. They plan to open about 11 restaurants this year. I think 11 new restaurants next year, and with a goal of having about 200 stores open by 2024. And I just like the fact that they're just kind of got this slow growth kind of built in, and they're not nowhere near saturation at that level, of course. I mean, Canada, United States, you'd probably have to have well over 1,000 stores to reach that, a point where you couldn't really grow your store base that much. So, and there's also international opportunities. They have expanded to Canada, but there's Europe and other places around the world. So I don't see future growth being an issue. And getting back to the actual share price, it's had a pretty good day today. We got down to 46, and we bounced up like over $1.50. So I did purchase just a few more shares today. Again, I don't know if this is really the bottom. We could easily get down to the lower $40 range. I put a pitchfork in here, which I kind of use, and it's been kind of staying along that bottom rail there, except for quite a good day today. So I'll see how this plays out. If the market continues to go sideways or up, I think at some point we're going to probably see a base come in. Because I didn't know when I first bought those shares, I knew it was a little bit overvalued. I sold a covered call right away at $60, and I got $1.45 for that. So you can look at that a few different ways. That lowers my price by $1.45, which is not insignificant. And it's also almost like making a dividend, because I received that premium right away. On one contract, that's $145, and it expires next January. The flip side to that is if the share price did take off and go through 60, even if it was at 70 or 80, I have to give those shares up at the $60. So that's kind of the loss. I felt at $60 the stock, at that price was quite overvalued, and the trend was down. So I felt doing that covered call was pretty safe. I'll probably continue that strategy. If it turns around and comes up a bit and gets back into the mid-50s, I'll probably do covered calls, 10 or 12% higher, 6 months out, just trying to get some income off it. Especially now, late days in this market, I do lots of covered calls just as a way to generate income. And then it kind of forces you out of the market a little bit too. If you're doing it on stocks that are already overvalued, they go up another 10%, go through your strike, then those shares are taken away, you receive the cash, and it kind of just builds your cash position automatically and takes you out of an expensive market. The long-term chart is, again, quite good, just because of its steady growth. You can see on the weekly price, I mean, just going back to late 2014, we were at $17 all the way to 72, and here we've came down to, I say 70, down to